Good evening, ladies and gentlemen. This is Barry Norman on behalf of investing.com, and welcome to our webinar on what you need to know about cryptocurrency exchanges. Now, this is the fourth of our five-part series on cryptocurrencies. Our last part will be on Sunday when we'll talk about regulations, laws, and governments involving, or where we think this is all going to move forward as the crypto world grows and gets the attention of all the governments and regulators around the world. Now, one of the most important aspects of cryptocurrency is a crypto exchange. And a crypto exchange are websites where you can buy, sell, or exchange cryptocurrencies for other digital currency or traditional currency like the US dollar and euro. For those who want to trade professionally and have access to fancy trading tools, you will likely need to use an exchange that requires you to verify your ID and open an account. If you just want to make the occasional straightforward trade or buy a crypto coin, there are also platforms that you can use that do not require any account whatsoever, don't require an account at all. And a great way to get Bitcoins, if you just want to quickly buy a Bitcoin to put away somewhere or move them over to your wallet, is through a site called Buy Now Crypto. And you simply get up to this screen and you put in your Bitcoin address, which is your wallet address because you don't have an exchange, and you decide how much Bitcoin you want to buy. It'll show you the purchase price, and then you just click to purchase, insert your credit card, and the coin is automatically deposited in the wallet address you gave, or if you have to pay somebody with Bitcoins, and you can just send it directly to their wallet without opening an account. So a great place to go is www.buynow-crypto.com, and you can use debit cards and credit cards quickly and safely to start purchasing Bitcoins and move them to your wallet. Now, like I said, exchanges are an integral part of cryptocurrencies. And there are a lot of different types of exchanges, and exchanges all work differently. So one of the things you have to learn and understand is the different types and the fees involved and how they function. Because otherwise, you can end up spending more money and time and missing potential moves because you're not dealing with the right exchanges, or the platforms you're dealing with are very slow. So we have three major types of crypto exchanges. First, we have trading platforms. And these are websites that connect buyers and sellers and take a fee for each transaction. So when you go to this kind of exchange, it'll show you all the people who are buying or selling cryptocurrencies and what price they're asking. And you simply conduct your business directly with that person, but through the exchange, and the exchange takes a fee for that. It's a slower process, but sometimes you can find better deals. And then you have direct trading. These platforms offer direct person-to-person trading where individuals from different countries can exchange currency. The direct trading exchanges don't have a fixed market price. Instead, each seller sets their own exchange rate. And then lastly, you have brokers. And these are websites that anyone can visit to buy cryptocurrency at a price set by the broker. Cryptocurrency brokers are similar to foreign exchange dealers, or imagine them as online, when you're going on vacation, you stop at one of those currency conversion places, to get your local currency. That's basically what they are. They have the price. They give you the price they're willing to sell or buy for, and they also own the inventory. So what you need to look for before joining an exchange, it's important to do a little homework before you start trading. And this doesn't matter. When we use the word trading in this case, it means anytime you exchange US dollars for Bitcoin or pounds for Ethereum, that is a trade. You are trading one currency for a different currency. So we're not talking about speculating yet. You just want to buy a Bitcoin or two, put it in your wallet, and put it away for whenever you want them. It's still a trade that you're making. So here are a few things you should check before making your first trade. So what you want to look for before joining an exchange: number one, reputation. Because most of these exchanges are not regulated, you have to depend on their reputation. And the best way to find out about an exchange is to search through reviews from individual users on well-known industry websites. You can ask any questions you might on forums like Bitcoin Talk or Reddit. Then you want to look into the fees, and this is a very important process. Most exchanges should have fee-related information on their websites before joining, and there's no cost to join an exchange. You just set up an account with them, and there's no deposit required, there's no action required. So you can have, and in fact, when we talk about arbitrage, you would want to have many different exchange accounts already set up. So before joining, make sure you understand deposit, transaction, and withdrawal fees. Fees can differ substantially depending on the exchange you use. Some exchanges, the transaction can take 2 days, especially if it's peer-to-peer, because somebody's offering to sell something at a price where they're not sitting online to accept your offer, and the exchange has to send them information, they have to turn it back, and everything has to get done. And sometimes it can be a 2-day process. Well, if there's a fast movement in Bitcoin and you want to take advantage of it, you want to make sure you're dealing with an exchange that's pretty quick. And then payment methods. What payment methods are available on the exchange? Credit and debit cards, wire transfer, PayPal. If an exchange has limited payment options, then it might not be convenient for you to use. Remember that purchasing cryptocurrency with a credit card will always require identity verification. It comes with a premium price, as there's a higher risk of fraud and a higher transaction cost and processing fee. Like one of the exchanges I deal with, they limit your credit card and also PayPal amounts, and each month that you're with the exchange, the higher they'll raise that amount. So what happens is you want to get into a deal, and now Bitcoin's selling it at $5,000, and that exchange will only let you take in $300 from PayPal. That's the maximum transaction, and each couple days they'll allow you to take a little bit more because they're worried about fraud. Once you've had your account for a long time, then they raise the limits. Some only allow you to take a couple $100 per debit card. Okay, and so you have to be aware of this before you get involved, because otherwise you might want to get in a trade or a purchase, and you find out it's a little bit too late to start dealing with these things. Now, verification requirements. Now, even though most exchanges today are not regulated because most governments are not involved or haven't issued direct rules about regulation, they do demand, and they are required to do know your customer, do identification verification to stop fraud and money laundering. So the vast majority of Bitcoin platforms, both in the US and the UK, require some sort of ID verification in order to make a deposit and withdrawals. Some exchanges will allow you to remain anonymous, although verification, which can take up to a few days, might seem like a pain, but it protects the exchange against all kinds of scams and money laundering. Then we have geographical restrictions. Some specific user functions offered by exchanges are only accessible from certain countries. Make sure the exchange you want to join allows full access to all platform tools and functions in the country you live in. And then lastly, exchange rates. Different exchanges have different rates. You will be surprised at how much you can save if you shop around. It's not uncommon for rates to fluctuate up to 10% or even higher in some instances. So be aware, check them out, and this, because this can eat into your profit very quickly. At $5,000 of Bitcoin today, and you want to buy one Bitcoin, now you can buy partial parts of a coin. But say you want to buy one Bitcoin and you can save 10% in fees. That's a lot of money. So remember, an exchange is where buyers and sellers conduct their business. A seller of Bitcoin deposits Bitcoin with the exchange's address. he can then use his positive Bitcoin balance in the exchange to sell his Bitcoin for dollars or other coins. Similarly, a buyer of Bitcoin deposits US dollars with the exchange and then uses the balance to buy BTC from other sellers. Now, once you have a crypto coin of any kind in your wallet or an exchange, you can do stuff pretty quickly. It's the slow part is when you need to access or buy. When you want to use your credit card, bank wire, payment address to get into credit cards. Once you own Bitcoins, to transfer them through an exchange to get Ethereum, it can happen very, very quickly. Once you've got your verification done, if you want to do verification and set up an account with the exchange, also that happens very quickly. But real exchanges are really just a medium between traders. People can set limit orders to buy and sell Bitcoins for a certain price. And that's it. Now we start to learn that not only do you go in and you can go to a provider that is selling you out of his own Bitcoins, or you can go in where you can set a buy and sell at a price. So you can say, okay, I'm willing to buy Bitcoin and place an order at $49.95 and Bitcoin say trading at $5,000, and it will get exchanged when somebody's willing to meet those conditions. So the exchange will match buyers and sellers when conditions of both the buyer and the seller are met. Now, there are two different types of orders that you can place with an exchange, and these are called limit orders and market orders. Limit orders allow a trader to buy Bitcoins at a lower price than the current price or sell Bitcoins at a higher price than the current price. However, these orders will only be executed once another user accepts them. Market orders will just find the best matching limit order. In other words, a market order says, execute my order now, buy me a Bitcoin, and it'll buy you the available Bitcoin at the best price that's available. A limit order, you specifically say what price you are willing to buy that Bitcoin in. And sometimes if there's a lot of active market movement, it might take a while for that limit order to be executed. So let's say the last trading price for 100 euro BTC, two people want to sell Bitcoins, but not for the 100 euros. One sets a limit order of 105 and the other at 110. So the best price to buy Bitcoins for is at 105. When a person places a buying market order, it will look for the best price and it will buy from the one trader for the 104. If the buyer wants to buy more than one Bitcoin, he will continually take the lowest price available. Doing this, the price of Bitcoin will increase as the lower price sell orders are no longer available. So let's start examining the inner workings of a digital currency exchange. Now, a digital currency exchange, the larger ones will post what's called their order book. Their order book will show you all the buyers and all the sellers and all the open orders that are out there at what price they are. So first, there's the electronic order book, which keeps track of buyers and sellers' interests. At every price level, this book records buy and sell orders, including their cumulative size, because size is important. If you say you want to buy one Bitcoin, and say Bitcoin selling today at $5,000, you're willing to pay $49.96. Okay. Now, there might be somebody who's willing to sell at $49.96, but he's only got 1/4 of a Bitcoin. So you could wipe that out, but you still have to get 3/4 of a Bitcoin. But there might be a guy at $49.99 that's willing to, that's got 3 different Bitcoins for sale. Okay, so you'll see this in the order book, and as the guy with the $49.96 gets wiped out, you have no choice but to go to the $49.99. So it'll list what they're selling, and that people can buy partial coins. So often you'll see order books displayed as tables showing open buy orders known as bids and sell orders known as asks at price levels below and above and below the last market price. So example, the next trade in the example above or the example on the right will execute either the bid at 96,281 in case the seller is stepping in, or at $98 if a buyer is willing to pay the ask. More on this later. It's important to note that transactions between sellers and buyers only occur if there are open bid and ask orders at the same level. You will never see this happen in an order book though, so there must be a missing piece to the puzzle. So to better understand how exchanges work, we also need to know that there are two basic types of orders, which we talked about, limit order and market order. Orders in the book are all limit orders, meaning they will only be executed if anyone is willing to trade at the requested price level. On the other hand, market orders are orders without a price tag attached. For this reason, they don't show up in order books. Instead, they are immediately executed at the best limit order in the book. So in other words, if you just wanted to buy your Bitcoin and you had seen Bitcoin was trading about $5,000 and you put a market order in, you might get it at $5,001, or you might get it at $4,999, depending on where that last order execution was, or the last open order. Okay. Now, traders who place market orders are eager to have the orders executed or filled as fast as possible. So the price is secondary. Now, what makes price move? So let's assume for a moment there are no matching limit and market orders at the exchange. There's a lot of limit orders in the order book, as shown in the example that we looked at, but no market orders are triggering any transaction. So that means there's either a lot of sell orders or a lot of buy orders, but they're not close to each other. There's not close enough to execute one. So clearly the order matching entry is out of work. No transaction will take place, and the exchange rate will stay at the price of the last transaction in consequence. And so price freezes, and so does the order book, so does the engine, until somebody else comes in and it makes a market order that starts moving the price. This will apply until the exchange receives a new market order, in which case one or two things will happen. If there's still enough limit order volume at the last transaction price in the order book, the new market order gets filled at the same price as the last transaction. Again, Bitcoin's price doesn't change. If there's not enough order volume to fill the market order, the exchange will fill the rest of it using volume from the best price level in the order book. In this case, the price changes to the next best price level, and voila, price of Bitcoin has moved. So the very short answer to the question would therefore be buyers and sellers placing market orders do move price. Now, this is just buying and selling. So it gets, as you can see, it's not so simple as you think. Unless you go into the exchange, it is the liquidity provider, and he's selling you out of his inventory. But then he only has market orders because you're buying from him at market. Now we get a little bit more involved in exchanges, because exchanges, or the big exchanges, offer what's called margin trading. Okay. So if you've purchased and have, not in your wallet, but at the exchange. Now, for security purposes, most people do not store their crypto coins at an exchange. They store their crypto coins in their wallets elsewhere for security purposes. Some people have them in cold storage, which is really on their own computer. And this is for security because the least secure place is an exchange. Now, exchanges, though, allow you to have margin trading. That means for every Bitcoin you have on deposit with the exchange, and you can move them in and out, you just have to have it there when you're going to make a trade, will allow you up to about 2.5 to 1. That means for every Bitcoin you own, you could actually purchase 2.5 times that without putting up any money, because you're technically trading it. This is for trading, not for owning. You can't move it over to your wallet and put it away. You can use it to trade. And this will allow you to capture short moves or quick moves in the cryptocurrency. So margin trading gives you access to additional funding from an exchange. These additional funds allow you to place larger orders and thereby multiply your gains and losses. Margins can also be used to sell or short assets which you do not hold. The amount of margin funding you can access depends on what? The value of your balances for the order book on which you have enabled margin, the leverage available on that order book, and your margin funding limit. Now, for example, the Bitcoin USD order book will allow you 3 times leverage. This means that if your combined value of your Bitcoin and US dollar balance is $100, you will have $300 of buying or selling power on that order book. So if you have 1 Bitcoin, hypothetically, and I use Bitcoins just because everybody knows what Bitcoins are, talking about Dogecoins or Litecoin. So because Bitcoin today is like tissue and Kleenex or Windex and glass cleaner, it's the generic anyway. It's the go-to term. So hypothetically, the market or the exchange might offer you on Bitcoin 3-to-1 leverage, and the maximum funding limit is $10,000. On Bitcoin Euro, maybe 2 times leverage, and the maximum funding is $3,000, because a lot of it has to do on price movement and liquidity. Then on the Ethereum, the US dollar, 3 times a maximum of $10,000 limit, and the Litecoin 2 times and only a maximum funding of $500 a limit. So a margin order consists of an order type, size, and price. The primary difference in placing a margin order is that you can access additional funding beyond your current balance to place your order. When this occurs, you might see a negative balance for the amount of margin funding you have used. Note that if you have sufficient funds for your order, you will not access additional funding and your order will be unleveraged. However, you will still enter a position. Once you have placed an order, leveraged or not, your position info will display it in the position panel. The assets from your order will also be added to your balance, but you will be unable to withdraw until your position is closed. So, if you wish to profit from growing Bitcoin price, consider opening a long position. So let's say, and this is just an example of one of the largest exchanges out there, and they all work pretty much the same, and their screens are fairly similar. So let's say the current price of Bitcoin is $600, which it isn't, it's $5,000, and you expect the price will grow. You can make profit by buying Bitcoins now for $600 and selling them later at a higher price. You have $300 on balance and open a long position with 1 to 2 leverage for 1 Bitcoin, which means you can use $300 of your own money to borrow another $300. 1 to 2 means for every dollar you have, you can have 2. So that means you now get $600 worth of buying power. You close the position when the price is $800. Then the $300 you have borrowed is automatically returned, and your profit is $200 minus the all-important word, your fees. Now there's a lot more that could have been earning using, this is a lot more than you could have been earning only using your own balance, because you doubled your profit because you used double the position. Now, you can also earn money when Bitcoin price goes down in terms of margin trading, and this is called a short position. For example, if the current price of Bitcoin is $600 and you expect the price will fall, then you can get profit from selling borrowed Bitcoins for $600 now and buying them back later at a lower price. And this is all done by the exchange. You're not actually buying and selling. Well, they're actually buying and selling through their order book, but you're not buying and selling. You're doing nothing. You have $300 on balance and you open a short position with 1 to 2 leverage for 1 Bitcoin, which means that you pledge $300 of your own money to borrow 1 BTC if it's trading at $600. You close the position when the price is $400. the 1 BTC you have borrowed is automatically returned, and your profit is 0.5 Bitcoins minus fees. This could be impossible without margin trading. So a margin position is simply a way of tracking your profits and losses. When you buy Bitcoins on a BTC USD book, you are entering a long position on Bitcoins. When you sell Bitcoins, you are entering a short position. You exit a position when you pay back any margin funding you have accessed and either realize the position, your profit or the loss, and settle your position. The fastest way to exit a position and settle margin funding is to simply close your position, initiating an opposite position. So in other words, if you had bought Bitcoin and Bitcoin went up, you would now sell Bitcoin, and you would, so if you bought the Bitcoin at 600, it went up to 800, you would then sell the Bitcoin at 800, and what would your difference be? Your profit would be the $200. Now you only had $300 in your account, so you have to pay back that $300 margin. So when you got your 800, you paid back the 300 margin, was left 500. You replace your 300, and what do you have left over? $200 profit. Okay. Well, you made $200 on your $300 investment. That's a very big profit. So imagine if you had 2,000 or 3,000. So Bitcoin interest has been growing lately, and with that comes volatility. Bitcoin is currently much more volatile than any other currency, making it a prime candidate for arbitrage. And before I get into details of Bitcoin arbitrage, it should be noted that it can be very successful. You have to learn how to do it backwards and forward, but it's a way that you can actually trade and make profit without actually understanding the reason for the moves, because it has really less to do with why Bitcoin or Ethereum is going up or down. It has taken advantage of different pricing from different exchanges. So currency arbitrage is the practice of taking advantage of price differences between different markets. These price differences emerge because certain exchanges are more liquid than others. Bigger exchanges with more trading will drive the price of the rest of the market. Smaller exchanges follow the price of large ones with a small lag. That small lag is what makes arbitrage possible. Bitcoin arbitrage is the buying of Bitcoins on one exchange where the price is very low and selling it at another exchange where the price is relatively higher. Because when you have Bitcoins or Ethereum or any of the altcoins, you have a wallet and an address. This allows you to easily move, using the blockchain, to easily move these coins from one exchange or one wallet to another very, very, very quickly without any cost and without any headaches. So you simply would have multiple Bitcoin exchange or exchange accounts open, and maybe you find that there's an exchange in Japan, like when Mount Gopa's there, that is a little bit lower, or because they're dealing mostly in Japanese yen, when there's a surge in the yen against the dollar, and you can see that maybe there you can buy Bitcoin USD for a lot less money, because you're not necessarily buying it with USD, you now own the Bitcoin. Okay. Bitcoin's in your wallet, it's yours. Okay. So you can say, okay, I've got that Bitcoin. Right now I can sell a Bitcoin in Japan for Japanese yen. Japanese yen are down, I can sell it back, or I can, the yen hasn't moved, so the Bitcoin US dollar over there is a little bit adjusted. You have to learn how to arbitrage. It's not that somebody's sending out a telegram telling everybody this is where you can do it, but this is just a matter of researching exchanges as opposed to necessarily understanding what drives market prices. The price of Bitcoin varies on various exchanges due to the fact that the markets are not directly linked, and the trading volume on many exchanges is low enough that the price does not adjust to the average right away. Or hypothetically, on a peer-to-peer exchange network, this guy posted it yesterday at $49.50 that he's willing to sell the Bitcoin. Okay, well, you were able to grab it from him, even though Bitcoin just happened to soar a few minutes ago to $5,020. You grab it up from him at $4,000 because he hasn't looked to change his price. You grab it up from him at $4,975, and you go sell it on the exchange that's willing to buy it from you at $5,020 because the price of Bitcoin had jumped off in New York. Okay. Now, you're not going to get rich an arbitrage, you're looking for little movements. You could get rich, but it means you have to do lots of trades and lots of coins. So imagine something fantastic happens with the value of Bitcoin. For this example, pretend a government decides all deposited Bitcoins will remain untaxed. This type of event would most likely cause many people to buy Bitcoin. Most people flock towards the most common exchanges because bigger exchanges are easier to trade in. Let's pretend this large exchange is Bitstamp or Coinbank, okay, one of the larger exchanges. The price of Bitcoin on Bitstamp will increase due to the surge of buyers. Meanwhile, at Camp BX, there is a low volume and the market is slower to react to change. For about an hour, the price of Bitcoin on Bitstamp is going to be more than it is at Camp BX. Okay. Or imagine, between New York and Japan, the Japanese exchanges aren't moving much because they sell mostly in Asia, and Asia's asleep while something's going on in America, or the Australian exchange. So you can find these. Okay, the price of Bitcoin in Coinbase is $650, and the price of Bitcoin on BTC is $636. The difference between the prices are $14. This is quite a decent opportunity for arbitraging. Let's say you buy 100 Bitcoins with BTC at the rate of $636, and subsequently you sell them at Coinbase Somebody just asked me, give me some names of different Bitcoin exchanges. No, I will not. Okay? You have to get up and do this research yourself. Okay? There is no standard method. Go online, search for them, look them up, and track them down. Okay? Now, subsequently, you sell at Coinbase at the rate of $650. You make $14 for Bitcoin. But let's get down to the math. Because when you haven't done your research and you're like this guy who wants everybody to hand him everything on a silver platter, then you miss all the ins and outs of those exchanges. So the price of each Bitcoin is $636. Total price of your investment, or what you had to pay to buy them, because you can't do arbitrage with an exchange's money. You have to remember that, because you can't move the money, the Bitcoins, from one exchange to another unless you own them. So here you had $636 times 100 coins, or your total investment was $63,600. Now the number of coins sold in Coinbase was 100. You sold them for $650 each, and the total was 650 times 100, or $65,000. So your total gross profit was $65,000 less $63,600, or a gross profit of $1,400. Now, it gets a little bit more complex than that. So say at 10 a.m. you could buy the Bitcoin at Camp BX at 101 and sell the same Bitcoin on Bitsmart for 105, making $450. This is what arbitrage is all about. And it really can be a foolproof method of investing if you understand and manage the complexities of the situation. So what are those complexities? Well, one point of confusion is the delay between exchanges during a Bitcoin transfer. This is because of something called the blockchain confirmation, an essential part of Bitcoin or cryptocurrency. Without going into technicalities, it's a process that takes about 10 minutes to complete. Most exchanges require 6 confirmations before allowing you to use newly transferred funds. If you're executing arbitrage, you'll need to wait an hour before selling the same Bitcoin on another market. As you see in the hypothetical timeline, is an extra hour can eliminate any arbitrage available. Now you can get around this limitation because you can do this by keeping a small balance of Bitcoins on the larger exchanges. You can take advantage of immediate arbitrage, and you're trading 0.1 Bitcoins during arbitrage, keep it at least at 0.1, and this is in the more expensive exchange. After an hour, your 0.1 Bitcoin will be transferred to the cheaper exchange, to the more expensive one. If you want to be able to conduct arbitrage more than once an hour, just keep a little extra funds in the more expensive exchange. But now you also have to worry about fees. You have to account for transaction fees when determining whether to conduct arbitrage. Most exchanges have a transaction fee of about 0.6%. This fee gets taken twice because it happens on each exchange. Arbitrage is absolutely still possible with fees just you have to account for them when calculating your profit. So in the above or the below arbitrage example, the fees would look like this. Bitstamp at $105, the fee was 63 cents. And at Bitcamp, the fees on $100.50 was 60 cents. So true arbitrage would have been 45 minus 123, or $3.27 in fees. So remember, in everything, you have your fiat deposit fees, which is when the cost of originally buying those Bitcoins, if you don't have them, from US dollars, pounds, or whatever else, and your fees to do that purchase. You also have the fiat withdrawal fees. So you make all that money, but you want to get it out of your exchange, you're still going to have to pay those fees for the Bitcoin to get it into US dollars. Now, there's no fee if you're going to use Bitcoins to Bitcoin. So like if you want to pay a bill with Bitcoin, there's no fees involved in that. You want to transfer Bitcoins, you want to pay somebody else in Bitcoins. Then there's the Bitcoin deposit fee, there's the Bitcoin withdrawal fee, and then there's the transaction fee. And the person said, is this referred to as mining? This has absolutely nothing to do with mining. So here's a simple arbitrage calculator. And you can just put in your cheap exchange, and that's where you're going to sell it at the cheaper price. And the expensive exchange, the difference between cheap and expensive is the buy and the sell exchange. Okay. So your Bitcoin rate was 636 on the cheap exchange, and your expensive exchange was 650. So your fiat deposit fee in percent was 1% to buy that Bitcoin with your credit card. And the exchange fees in present are 0.5, and the Bitcoin withdrawal fee in Bitcoins is 0.001, which is a transaction fee for moving Bitcoin around, which is a tiny little amount of money. And then you have your deposit fee, which is equal to the same as your withdrawal fee. And again, that's the blockchain transaction fee. And then a fiat withdrawal fee is 2%, and the fiat withdrawal time doesn't make a difference. Now, the number of Bitcoins arbitrage is 100. So the estimated revenue was 62,120. The invested money was 6360 for a net loss of 1480, which could have gone against you. But if you were selling short, it would have been a net profit for you of 1480. So overall, Bitcoin arbitrage may be an opportunity to make some passive income, but at the same time, it has risk. Moreover, almost all exchanges have an API, and these can prove to be very prosperous for you. Utilizing these APIs will give you tools you need to create a custom arbitrage bot. Or today on the markets, there's a whole bunch of arbitraging bots, which you can buy and download, which will monitor all of the exchanges you set up and constantly search for arbitrage opportunities for you. Now, utilizing the APIs will give you the tools you need to create a customized arbitrage bot or hire someone to do it for you. Still, even attempting to arbitrage manually can be very beneficial as long as you watch closely and make sure you're placing simultaneous trades. But it is one of the nice ways that you can profit in the cryptocurrency markets without understanding why Ethereum's going up or down, why Bitcoin's going up or down. You simply are looking for the right price at the right exchange. You're looking for one exchange is selling or buying cheaper or higher than another exchange, and you simply become the middleman in between. And it can happen quickly and easily, and before you know it, you can spend your whole day doing this backwards and forwards. And if you're making $40 or $50 or $100 an hour on each trade you make, well, sometimes it's better than working. If you're making $100 an hour and do this for 6 or 8 hours a day using a bot and some other things, you've made yourself $600 or $800 each day. Well, it's a nice way to make money. So thank you very much for joining us tonight, and we'll see you on Sunday. And you can, somebody asked me, how can I get the previous webinar? Go on investing.com, go to their webinar section, and locate their recorded webinars. Thank you very much, and thank you for joining us. This webinar has been recorded, and you may access this one by using the same link you came to tonight's class. It'll be available in about 24 hours. Thank you very much. Have a good night, and good luck out there with exchanges and arbitrage.